Saddam Security. And no, not Saddam Hussein's private security team, actually a contract where you could bet on his life. I guess quite the contrary. These odds were dynamic and were similar to other futures markets. Think your gold, your oil, your wheat, your corn. And then there's betting on the murder of a dictator. So the National Bureau of Economic Research put out this piece that found strong evidence suggesting the price movements of Saddam security futures reflect underlying war probabilities. And so naturally, if this security impacted underlying war probabilities, the movement of the security also impacted how the market felt about war in Iraq. Imagine this. You had Wall Street investors hedging their portfolio against what seemed like an oncoming war, and that ended up being the case in 2003. The Saddam security is traded a little more widely and liquidly than the typical contract on the Iowa market, and Wall Street is overrepresented among market participants. But what does this have to do with the title of this video? Does war matter to the stock market? And obviously, on a hierarchy of what's most important during war, the stock market isn't one of them, but that's what we're here to look at today. So this isn't to undermine all of the horrible things that are going on out there. This is just to take a logical step through of what tends to happen to investor portfolios when there's war. With that out of the way, I think if we can answer these 3 questions, we can build a pretty solid foundation to answer the title of this video. 1, does war hurt or help an economy? If so, how? Does your position in a war hurt or help? Are you the aggressor? Is the war fought on your home soil? Is it a civil war? Is it across boundaries? And lastly, does any of this matter? Although new war headlines seem to be popping up every single morning, it's important to realize that we are currently undergoing the most relative peace we've seen in human history. All right, first things first, we need a lot of data. Thankfully, this dirty work was done for us with the Economies of War and Peace, where they examined over 700 wars spanning the last 200 years. To cut to the chase, the results weren't very good. On average, GDP per capita gets absolutely destroyed relative to its pre-war level before starting to recover. GDP per capita isn't a perfect measure of the stock market. It's certainly a good measure of the economy, but we'll get there. The 20 sharpest contractions in the dataset see GDP per capita drop by between 40 and 70%. This graph makes the story loud and clear. Huge disparity. This synthetic estimate, just think, based on other countries with similar economic dynamics that were not in war during the same period. So let's say the United Kingdom was at war, we'd probably want to look at France, Germany, or Canada's economy to get a fair representation or estimate of what the UK probably would have been doing during that time. So obviously things look pretty grim. And there's about 50 other graphs outlining impact of war on your own territory or in another country's territory, whether the war was civil or interstate, whether the country was the initiator or the attacked, winner versus loser of the war. I think you get the point. There's a lot of data, but almost all the data exclusively points to negative economic impact. But I thought stocks only go up. After all, today we have ongoing conflicts between Ukraine and Russia, Israel and Iran, Israeli-Palestine, civil wars in the Middle East. So why is it that we have many stock markets at all-time highs? The stock market in the United States has literally been hitting all-time highs for the past 20 years, it seems. Obviously with volatility, ups and downs, but generally speaking, it moves up. Yet the US has been involved with war in the past 20 years. So let's take a look at what these wars actually looked like. There's really 3 general states in war that you can fall into. You can be directly involved in the war, risking human life. You can be not involved in the war, which economically speaking, as we just saw, is probably the best decision. Or 3, you can be indirectly involved in the war or via proxy. So since 2000, the US has led invasions in Afghanistan and Iraq, directly involved in the war, but also has supported partner forces in conflicts like the Syrian civil war, the Yemeni civil war, obviously Ukraine versus Russia, and most recently the Israeli-Palestine conflict, as well as Israel versus Iran. And what do all of these have in common? Well, are they directly involved? Are they risking human life? Human capital? According to the Council on Foreign Relations, the United States has provided over $128 billion in monetary aid to the Ukraine government in their fight against Russia alone. Well, yeah, a lot of different things, let's say. How does this help us answer the big question? Well, we've seen how war, on average, negatively impacts the economy, but like we said, that doesn't mean necessarily the stock market will go with it. In this example, let's take a look at who is actually benefiting. What do the economies and the stock markets of the participating countries in this war look like? Well, since the start of Russia's invasion of Ukraine, their GDP was literally cut by a third in 2022. And their stock market, well, hasn't been open since the day Russia invaded. So I think we can safely say the party benefiting certainly isn't the Ukrainian people or the investor. Well, how about the other side? We have a country that is ranked 11th in the entire world in terms of nominal GDP, so an absolutely massive economy. Russia's economy has stayed relatively resilient, especially compared to their opposition in Ukraine, but was also halted the day the war began and reopened a month later down 33%, with some other measly restrictions that probably didn't leave investors feeling too confident in where their money was. And today the stock market's roughly down 30% from all-time highs. On the flip side, we have the three largest donors to Ukraine during this war in United States, the United Kingdom, and Germany, all at or near all-time highs. So as we mentioned, all of these countries, not technically involved in a proxy war, but one could argue, based on the stock market, these countries seem to be, dare I say, benefiting. But I think there is a detail that we've neglected that would be in line with conventional wisdom. And that is, if all of these stock markets are at all-time highs, you'd think that defense and aerospace companies would be benefiting the most. And no, actually, that's not true at all. Since 2017, the largest defense and aerospace contractors have significantly underperformed the market. Now, this is important to bring up, right? Because if we're weighing the impact of war on the stock market, you'd think the sectors that are most likely to be involved in, the support of Ukraine via that massive list of assets that we provided, a lot of that revenue, a lot of that money would be flowing to the hands of these defense contractors. All right, that's interesting. But let's look at another example of a war and come back to this. We looked at an instance where the United States was involved in the war via proxy, but what about a time when they were directly engaged in the war? The Iraq War. The United States, United Kingdom, and Poland were directly involved. Yet the US stock market doubled over that time, the UK nearly doubled, and Poland nearly tripled. The United States economy in particular experienced certainly a more negative impact than positive. To be frank, the data is all over the place. We're trying to stay post-2000 with this analysis because the dynamics of war and economies are more different today than it ever has been in history. So what did we learn from these two brief case studies, and how can this help us answer the third question of building our foundation that we asked earlier? Does any of this stuff matter? Of course, in terms of stock market performance. Well, for one, war and its impact on economies and stock markets is rather complex. You could be the initiator, the defender. The war could happen on your soil or overseas. You could be fighting a proxy war. But you know what? The question is, will the war still allow for a conducive environment for business growth? At the end of the day, if businesses increase earnings, their stock will rise as well, ultimately rewarding investors handsomely. Consider this. Do you think a war between Iran and Israel or Ukraine and Russia is going to stop that seemingly limitless appetite for AI demand from the biggest companies in the world? Do you think Nvidia is all of a sudden going to change their business model when they have companies literally begging and paying billions of dollars for their latest and greatest chips? As we logically work through this example, nothing has fundamentally changed. It's all circumstantial. A country like Ukraine can't afford a war of attrition, and so their economy was completely crippled. So was their stock market. Think about it from the perspective of an investor. Forget about any sort of foreign investment from the perspective of Ukraine. Too much risk. There are plenty of returns to be made elsewhere. As we briefly mentioned, Russia, as the world's 11th largest economy by GDP, obviously isn't as impacted by the war as Ukraine is, but even still, their stock market is nearly at the same level as it was 3 years ago. This should make sense. 30% of Russia's GDP is from the sale of energy. After engaging in the war, the US banned the direct import of Russian energy into the country, with many European nations following closely behind, or at the very least, importing less. So you can see when so much of Russia's economy and stock market depends on the performance of energy-related business, earnings may not be exactly skyrocketing, nor attractive for domestic or foreign investment. All of this to say, well, there's really no evidence to suggest that war is guaranteed to impact the stock market in a positive or negative manner. Although conventional thinking would suggest a negative impact, a logical argument would weigh the circumstances. How do businesses that, generally speaking, derive their stock market performance from their financial performance, with some clear and obvious exceptions, how will they perform before, during, and after the war? Does it matter? Does it change their consumers' appetite for their products? Will it change their business model? Will it have them increasing production, decreasing production, growing earnings, or not? If you're a country like Russia, with many businesses that rely on the distribution of energy, and your energy lines get destroyed, then I think it's safe to say it'll show on the bottom line, and investors won't be too thrilled about the prospects of future growth. And yes, I guess it's kind of a lame conclusion to reach, but there's just so much complexity in underlying dynamics when it comes to market performance. As we've worked through this analysis, I think it becomes now abundantly clear that massive financial events like the dot-com bubble, the great financial crisis, COVID, those things that fundamentally change the way businesses are valued and operate play a much bigger role than the connotation of war, whether that be direct involvement, no involvement, or proxy. If anything, I think the most valuable part of this investigation tells us that war doesn't have a guaranteed impact. And moreover, geopolitical tensions that cause pullbacks with no fundamental shift in business strategy or potential performance are probably investing opportunities, not red flags. Maybe the real winners after all were the people hedging their portfolios betting on Saddam securities. In fact, today we have betting markets like Polymarket, where you can wager money just about on anything that you want, including outcomes of war. So if you're truly worried about war and its fundamental impact on the companies that you invest in, maybe there'd be some merit to hedging with wartime futures. We live in quite the freaked up world, man. I hope this analysis was helpful in some way to you and your future investments. If it was, consider subscribing or don't. Thanks. See you next time. And be careful out there. Peace.